Okay. This chapter, obviously, it's all about budgeting, right? That's a big part of managerial accounting. Estimating what your sales are going to be, what your costs are going to be. That helps you figure out how much material you need to buy, how many workers you need to schedule or hire, right? So budgeting is really important for management. We are going to cover, I can't even see what that says, how and why managers something. Use budgets, maybe?
Yeah.
Yeah, okay. And then there are two basic classifications of budgets. There are the operating budgets that have to do with your operations. And so that would be anything related to sales, production, and even administration. All of that falls under operating budgets. But then we also have financial budgets. That has to do with cash flow and paying for capital purchases. Together, the operating and the financial budgets make up what's called the master budget. Okay? We'll learn what flexible budgets are. Those are useful because you never know what your sales are actually going to be, right? So what a flexible budget does is it allows you to adjust your costs based on your actual sales. We'll learn how to do that. And we can look at how budgets are used to evaluate goals. All right. Okay, here are some different approaches to budgeting. Has anyone ever been involved in budgeting in the workplace where you helped create a budget? No? Okay. We had, we do that here, for example, the business area, you know, those of us who teach business. Every year, if we want some money for something, we need to put in a request for that to be part of the budget. We have to justify why we need that thing. We usually don't get what we want, or at least not what the full amount that we asked for, but it's because there are limited funds, right? So the district has to decide how much each discipline gets and how much each person gets, you know, based on what they requested. So some different approaches to budgeting. One is a top-down approach where the executives basically say, this is how much you get. Basically, them telling you this is what you have to work with. Bottom up is workers, maybe supervisors, saying this is how much we think we need. And then they don't have the ultimate say, but at least they can put in a request like I was saying we do here. So it's really starting with the bottom, and then the top level gets to approve it. Now, a lot of companies, what they'll do is they'll base the next year's budget on this year. So they'll look and see how much money did we spend this year, and maybe next year we think we're going to have more students or more customers. And so we'll take this year's budget, and then we think we're gonna have 10% more customers, we'll increase our cost by 10% to try to keep up with the increased number of customers. So that is the traditional approach. You base the next budget on past budgets, okay? There's also a zero-based approach. Some companies say, nope, every time we make a budget, you start from zero. You have to justify every single cost. You say, we think we need $100,000 for new equipment this year. Tell us why. Don't say because we got $100,000 last year for new equipment, so we think we should have $100,000 this year. No, it doesn't matter what happened in the past. You have to justify every cost every time we make a budget. So that's called a zero-based budget because you start from zero. Okay. Then we have a flexible budget, which I already referenced earlier, where you can adjust the expected costs based on the actual sales. And we have a rolling budget. We'll get into that as well. That's basically where you always have a budget that goes out for a year. I'll show you a graphic display that illustrates that more clearly. Okay, so let's just think about budgeting. Imagine you are planning to go study abroad, okay, in another country. That's what I mean by abroad, in case you didn't know. Okay, you're going to go study in another country, and so you have to think about how much income are you going to have, and what are your expenses going to be, right? It's like an income statement: revenue minus expenses. So what's your income? Well, you're going to be doing a little bit of work. You got some student loans and a scholarship. Hopefully that's mostly scholarship, not mostly loans. You are going to use some of your savings, and that gives you a total of $36,000 that you can use during that year, right? And then you have to think about, okay, what are my costs going to be? You got your tuition, room and board, books, sightseeing, right? Since you're in another country, might as well see the country. Travel expenses, airfare, or, Uber, that sort of thing. And in this case, if your expenses come up to $35,000, you've got $1,000 left over for emergencies. What do you think about this budget? Does it seem reasonable? Is there anything you might be questioning that it might not be that accurate? What do you think? Would you feel comfortable with this budget?
No.
More emergency, especially abroad.
Okay.
You never know.
Okay, $1,000 doesn't go that far. Might not even be enough to book a flight if you needed to come home early. So yeah, maybe find a way to increase this. What's that? How could you, Jahira, go ahead. A what? Food budget. Well, that'd be board. Room and board. So room is your accommodations, and board would be for food. Yeah. So what adjustments could we make if we felt like we needed more than $1,000 emergency fund? Could we increase our income somehow? Okay. Or we could think about different ways to get these numbers up. Maybe apply for some more scholarships, do some extra work, whatever. Okay, and what about expenses? Is there anything we could do maybe to reduce some of these expenses?
Lower sightseeing.
Okay, lower sightseeing. Okay, so lower sightseeing, and what else?
Get your books online.
Get your books online.
Don't
travel.
Okay.
don't travel.
We have to get to the other country, but maybe you could find a way to get these travel costs down. Yeah, right. So this is why we need budgets. Because what you don't want is a situation where you're running out of money. Right? So that's why we have budgets. Okay. As I mentioned, you can budget from the top down, where the top level just basically tells you how much money you get for your department. Or in a lot of companies, they will ask for input from the lower levels. And then they'll take that recommendation or request, evaluate it, and it's the executives that get to decide, but at least they're considering the needs of the lower level management. Okay. All right, so that's pretty basic. As I said, traditional and zero-based are two approaches to budgeting. Look at the steps involved, okay? Here are the steps for traditional. Here are the steps for zero-based. What's the difference? A lot of the steps are the same, but what's different?
Yeah.
Okay, exactly. So with traditional, again, it's based on the previous budget. With zero-based, it's what are your goals? And you're starting from zero to justify what money you need to achieve those goals. Okay, so that's the primary difference. Here we get into flexible budgets versus a budget that's not flexible is called a static budget. Static meaning it doesn't change. So let's say this is your company and you've estimated a certain amount of sales for the year. In this case, let's see. Does it tell us the amount of sales? No. All we see here are the costs. Okay. So, oh yeah, here's sales volume. Sorry, it is here. Okay, let's start right here. I know there's a lot to see, but let me start in this column, budgeted sales volume. And this is the static budget. Again, the static budget does not change. So the company said, we think we're going to sell 72,000 backpacks and 35,000 purses. Now that's an estimate, right? So it may or may not be too high, too low, we don't know. And if they sell 72,000 purses, their cost for backpacks, if it's $5.72 per backpack, would come out to this. And if it's $7.46 per purse, would come out to that. Okay. So that way you can, once you know what your actual sales are, you can also look at what your actual costs are and see how did we do. But it would be a little bit hard because what if your sales were not really 72,000? What if your sales were 71,600? Then what should your cost be? Well, with a static budget, we don't know because it's static, right? So with a flexible budget, what we do is we take the actual sales volume, multiply it by the cost per unit to see what our actual costs should be. Okay. Same thing for labor. The static budget is based on the estimated sales. The flexible budget is based on the actual sales. You don't know the actual sales until it happens, right? So really, it's not that much additional work. Once you know your actual sales, you can just adjust your budgeted costs based on those actual sales with a flexible budget. And that gives you a more realistic picture of how you did in controlling your costs. Same thing with overhead. So now let's compare. We see if we take the difference between the budgeted, the static budget for the cost of the backpacks and the flexible budget for the cost of the backpacks. We see that the flexible budget came out $2,288 less. And when we're talking about costs, we want them to be less, right? So when our costs come in less than what we thought, that's favorable. But here, what we're comparing it to, it's not really a good comparison. The reason it's less is because we sold fewer backpacks, right? So really comparing your static budget versus your actual budget is not super useful. What you really want to compare it to is the flexible budget's costs versus the actual costs. And actually, they didn't even give us the actual costs here. So this would not be the most useful thing, but it's really just to illustrate that there's a difference between what you get on the flexible budget based on the actual sales, what you get on the static budget, which is based on the budgeted sales. Okay. Any questions about that? All right, so let's move on. This is a rolling budget. So typically companies budget out for at least a year at a time. It's kind of hard to know more than a year out what our costs going to be. Your suppliers might change their costs. Fuel prices can change. You might end up changing your sales price on your product. There's so many variables that the further out you're trying to budget, the more you're guessing, right? But it is common to have at least a 1-year budget. With a rolling budget, notice they start off with a budget that covers 4 quarters, which would be a year, right? And then what happens after 1 quarter goes by, now they're in quarter 2. So they could add another quarter, the 1st quarter of the next year. So now they still have a 12-month budget. They just pushed it out by 1 quarter. And then the same thing, another quarter goes by, they add another quarter at the back end. So they're always estimating out a year, and they're updating it every 3 months. That makes sense, right? Because every 3 months you have a better idea of what's coming a year from now than you did 3 months before. So that's called a rolling budget. All right, any questions on that? All right then. This is the master budget, which involves all the other budgets, okay? We always start with the sales budget. Why do you think that would be the logical place to start? Emma? Where your revenue comes from, true. And therefore, okay, yeah, so that gives us an idea of our income, what we have available to spend, and it also tells us how much we need to produce to support those sales. You're planning to sell 100,000 units, well, you better have 100,000 units available to sell, right? Otherwise, it won't do you any good. So our sales budget informs our production budget. So we know how much we need to produce. Now, if we know how much we need to produce, then we can figure out how much material, labor, and overhead we're going to have. Or at least an estimate, right? Because those are the 3 production costs: direct materials, direct labor, and manufacturing overhead. All is dictated by how much we're going to produce. Right? The more you produce, the more you're going to have costs in those areas. Then also, based on how much we've sold, we could then figure out what do we think our selling and administrative expenses are going to be. Right? Because the more we sell, the more we're going to have those expenses. And then we can make what's called a budgeted income statement. It's just like an income statement that we're used to. It's just that it's based on our estimates, not on actual performance. So we could take these costs of goods sold that we've estimated. We could take the sales revenue we've estimated and put that all into a budgeted income statement. And this all makes up the operating section of our master budget. Okay? Any questions on that? Operating budgets. Okay, well then we get into our financial budgets. So we have to figure out how much cash is going to be coming in and going out. That means we'll need what's called a cash collection schedule, where we look at our accounts receivable and how much money we think we're going to get. And also our cash payments schedule, where we figure out how much we think we're going to have to pay to our suppliers. In addition to those schedules, we have to figure out capital purchases. If we're going to buy equipment or real estate, those are pretty big purchases, right? That's not part of our normal cash flow. We might have to go out and take some loans out. We might have to sell some stock. So we're going to think, how are we going to fund these capital expenses, and what impact is that going to have on our cash budget? If we issue bonds, for example, great, that'll generate some money, but then we're going to have to pay interest on those bonds. So how does our capital budget impact our cash budget? And once we figure that out, then we can make a budgeted balance sheet. We'll know our estimated assets, liabilities, and equity. And just like any other balance sheet, just make a balance sheet. It's just based on estimates. Okay? And this all together is our master budget. So this is what we're learning to do this week. Okay? So who's got a question? I wouldn't? Okay, fine. Then let's start with the sales budget, because again, that would be the first one you would create. This is a company that makes bikes. We have the number of units they're planning to produce every quarter. I'm sorry, I said that wrong. The number of units they're expecting to sell, right? Which is different than produce. So the number of units they're expecting to sell every quarter times the sales price. Notice they're planning to increase their sales price in the third quarter. We have to take that into consideration. But they still think that their sales volume is going to be going up. And that can help us figure out how much revenue they can expect to bring in every quarter. Now, we know revenue is not cash, right? We might sell some bikes and not get paid immediately. So that we're going to have to figure out later when we get to the cash budget. Now we're just looking at how much revenue. And that's not too hard, right? Number of units that they expect to sell times the sales price. Pretty easy. All right. Oh, wow. Already an exercise. What do you know? Okay, let's do this one. That's right. All right, exercise 3 looks like this. So this is a sales budget. This company makes these GPS devices that cost $50 each. And in this case, they're not planning to change the sales price. So I'm going to go ahead and put that $50, oops, let's try that again, in this middle row, and it's going to be the same every quarter. Okay. Now they tell us here that they expect to sell 5,000 units in the first quarter and a 5% increase each subsequent quarter. So if we're selling 5,000 units here in Q1, how would we figure out what 5% more than that would be? Yep. Okay. Yeah. So the easy way to do it, if we multiply by 1.05, we'll know how much is 5% more. Right? If we only wanted to know the 5%, we could just multiply by, what was it? Yeah, 0.05. But if we want to know what's 5% more, it's 1.05. So that means in Q2, we're selling 5,250. Let's go ahead and do this one together. If I hit enter on the calculator, it's going to multiply by 1.05 again. But you notice we get 5,512.5. And we know you can't have 0.5 of a unit, right? So we're going to round that up to 5,513. And then if we do the same thing, we take the 5,513 times 1.05. That means in Q4, we now have 5,789. Right? So if we're increasing 5% every quarter, that's what it would look like. Then if we want to know our total units we expect to sell for the year, we just add them up, right? So let's do that. Does that look right? 21,552? Yeah, okay, thank you. Okay, and then we just multiply by $50 for every quarter to figure out what our sales revenue is going to be. So I think in a lot of ways, this chapter is not that hard, but there are a lot of calculations involved. That's why some of the problems will take us a while to get through. There are a few of them that are somewhat tricky, but for the most part, it's just time consuming. Okay. All right, let's see if I got that right. I'm gonna add up all 3 quarters of sales revenue. 1,077,600. Is that what you all got?
Yes,
Yeah. And how could we double check that?
by taking our total expected sales in units and multiplying that by the sales price.
Exactly. We take our sales in units, and because we did not change the sales price at all during the year, we just take the total number of units times $50. We see we got the same number. We must have done it correctly. And now we have our sales budget for the year. Right? Any questions on how we did that? Anybody still taking notes? Looks like you're all done. Oh, you are, okay. All right. So that's a sales budget. That's really all that you have to do with the sales budget. Of course, if you had multiple products, it would get more complex, but in this chapter, it stays fairly simple. Okay, got it. Okay, all right, let's go ahead and see what's next. So, okay, after we have our sales budget, we need our production budget. All right. Yeah, oops. Sorry about that. My wrist bumped the mouse. Okay, let me zoom in on this. As you see here, this bike company uses 3.2 pounds of material for every trainer. Not really, anybody know what a trainer is in terms of bikes? Oh, really? Okay. I would think it would take more than 3.2 pounds of material, but I don't know. Maybe it makes sense. I don't know. Okay. Every pound of material costs $1.25. Okay. Now, this is one kind of tricky part of this chapter. It says management has a goal that they have 20% of the next quarter's material on hand at the end of the previous quarter. So what that means, let's say you need a certain amount of material this quarter, okay? And you use up all that material. And then the next quarter comes and your new material has not been delivered. Production stops. So you want to have some extra material available at the end of every quarter so that you can make sure you've got material to work with in the next quarter. Okay. Oh, how did I get to materials budget? Okay, let's back up to production budget. But the same concept applies with the production budget. Your salespeople want to always have something to sell. If they sell all of the units you had for the last quarter, now we get to the next quarter and there are no units available, they can't sell, right? So you always want to have some available units ready for the next quarter. Okay, let's start here then. In this case, the company has said they want ending inventory to be 30% of the next quarter's sales. So this is a sales budget for this bike company. And we can see how many units they plan to sell every quarter. Okay, you see that? Expected sales in units. Now let's look at their production budget. See how the first line is their expected sales, right? That's a little bit too big. Okay. So from the sales budget, we take the expected sales, bring it over to the production budget. But remember, they want to have 30% of their ending inventory available for the next quarter. So the salespeople have some stuff to sell. So in quarter 2, they're expecting to sell 1,000 units, right? So they want 30% of that available at the end of quarter one. That's their desired ending inventory. And if you follow it across, you see in Q3, they're expecting 1,500 units of sales. 30% of that is 450. In Q4, 2,500 sales or units, 30% of that is 750. You have to kind of go back and forth, make sure you have the 30% of the available units you need at the end of the quarter for the next quarter. Okay, so got that? Okay. Then if you add them together, what you expect to sell plus your desired ending inventory, that tells you your total units required for that quarter. Ones you're going to sell plus the ones you have available at the end of the quarter. But we can subtract from that any beginning inventory that we might have already had. Now in their first quarter, they didn't have any beginning inventory, right? But you see in Q2, remember that 300 that they wanted at the end of Q1? They have those 300 units at the beginning of Q2. Right? Because the end of one quarter is the beginning of the next quarter. So that means we can subtract the beginning inventory and they only need to produce 1,150 bikes. Okay? Was that a question? No, okay. Let's look at Q3. How much they're planning to sell, how much they want to have available at the end of the quarter. That's the total number of units they need, but they had a beginning inventory of 450, right? So that means they only need to produce 1,800. And you see that 450 beginning inventory was the ending inventory from the quarter before. So if you look, you see how there's a zigzag pattern, right? We have 300, 300, 450, 450. 750, 750, right? See that pattern? We're going to see a lot of that in this chapter. And the sooner that pattern makes sense to you, the easier this chapter is going to be. Any questions so far? Okay, so now we can look at the material budget then. For the material budget, we have to start with required production. We have to know how many bikes we're planning to produce so we can then figure out how much material we need, right? So in other words, production budget came from the sales budget, but the results of the production budget goes here at the beginning of the materials budget. Now with materials, it's the same thing. We need a certain percentage of the materials available at the end of every quarter so we can start producing right away and not have to wait for a delivery. So here it says 20% is their goal. That means, let's start right here. Okay, here they're just multiplying how many units they're planning to produce times the amount of material per unit to turn that into how many pounds of material. So for quarter one's planned production, they need 4,160 units of material. Now, that's not units of product, right? This material is measured in pounds. So when we're talking about this material, a unit is a pound. If we were talking about, well, we have another exercise we're going to do together that is solution for contact lenses. So it's in ounces. So a unit would be an ounce. Or maybe it's square feet. So a unit would be a square foot. Okay, so keep that in mind. When we're talking about materials, their units, it's different from units of product. So here we know how many pounds or units of material we need for this planned production. But remember, we need 20% of next quarter's planned production for the end of this quarter. So 20% of that we put here. Then we add that together. That's the total material we need for this quarter. minus what we started with, which again is 0 in this case. And so that's how much we are going to need to purchase of material. Multiply that by the cost per pound for the material, and we get the total cost purchases for material for this quarter. Okay. Let's look at the second quarter. We know we need to produce 1,150 bikes that take 3.2 pounds of material each. So that will be this much material, but we need more than that, right? You need to have some ending inventory that is this 1,152. How did we calculate this 1,152?
We took our total pounds needed for the next quarter, which is quarter 3, and we multiplied that by the 20%.
Exactly. We take the next quarter's pounds needed for production, and we multiply that by 20% to get this ending inventory. Okay, critical step. Any questions on that step? Next month's production material requirement times whatever percentage, in this case, they told us 20%. Okay, and then we add those together to see the total amount of material we need. And then we take the beginning material out, we subtract it. Now, where did this 736 pounds of beginning material come from?
The desired ending inventory for the last quarter.
Exactly. It's the desired ending inventory from last quarter. It's also, the 736 is also 20% of this quarter's pounds for production. So you can find it either way. Look at last period's ending inventory or apply the percentage to this period. So 20% times that also gives us 736. Okay, so that's how it works. Again, a lot of calculations this chapter. Are there any questions on the direct materials budget? All right then. Direct labor. Direct labor is not as complicated because you can't store it up. You can't have like some 20% of next quarter's labor this quarter, right? That wouldn't work, right? Maybe somehow we'll figure out how to do that someday, but today there's no way to do that. So where you start with, again, is your production budget. You take the number of units, just like we did here in the materials budget. We started with how many units we need to produce. Same thing here. In the labor budget, we take the number of units we need to produce from the production budget. That's where we start. Okay, then we see each unit we produce requires 0.75 hours of labor. What would that be in minutes? 0.75 hours would be
45 minutes?
45 minutes. 45. So every quarter of an hour is 15 minutes, right? If you get confused on that, let me think how you would do it. So you would take well, an hour is 60 minutes, right? How would you do that? 1 divided by let me think this through. Yeah, that's what I'm trying not to do. Okay.
60 times 3/4?
There you go. That'll do it. Good, yeah. So we know there's 60 minutes in an hour, right? So if you take 60 times 0.75, it's 45 minutes. But what if you wanted to do it the other way around? You wanted to know how many minutes, no, that's what we know. You wanted to know what percent, I know. If you wanted to know what percentage of an hour is 45 minutes, you could take 45 divided by 60, and you get 0.75. So anyways, that might be useful at some point. All right. So we know that 45 minutes is 0.75 hours. Yep. So we just multiply the number of units times 0.75, we see how many labor hours, multiply by the rate per hour that the workers are getting paid, and we get our labor cost. Okay, a lot more straightforward than materials. Any questions on the labor budget? Now, we'll just assume that this includes benefits, you know, the $20 per hour, because that's part of your labor cost too. Okay, then we get into overhead. This looks complicated, but it really isn't. In this case, the way they're applying their overhead is by labor hours. And it was a total of 975, for quarter one, it's a total of 975 labor hours, right? So they're taking the labor hours. They've got 4 different cost pools for their overhead, for their variable overhead costs. So they found that indirect material is $1 per direct labor hour. So 975 direct labor hours times $1, 975 bucks. For indirect labor, it's $1.25 per direct labor hour. So you just multiply 975 times 1.25 and you get the amount. So that's just the way that they've broken it down, okay? And then you can add up all of their variable overhead costs to get your total variable manufacturing overhead costs per quarter. Now the fixed obviously stays the same, right, per quarter. So those numbers just get plugged in and added up. And then if you add your variable to your fixed, you get your total. All right. So it looks like a lot going on, but it's really not that complicated. So any questions on the overhead? Okay. Then we have sales and administrative. In this case, every bike that gets sold, there's a $2 commission that gets paid to a sales rep. You have to sell a lot of bikes as a sales rep to make a living, I guess. And there's a 50-cent transportation cost. All right. And then we've got some fixed sales and administrative costs too. So since commissions and transportation are based on how many units we sell, we take our sales budget times $2 for the sales commissions, times 50 cents for the transportation costs, add them together, you get our variable selling and administrative costs. Then again, bless you, the fixed costs stay fixed, so we just plug those in and add them up, we get our total selling and administrative costs. Right? Any questions there? And that is the last budget in the operating budgets, right? So now, the next thing we would do would be the budgeted income statement, but I don't think we're quite there yet. Here, let's see our total cost, putting everything together. Let's go back to direct materials, direct labor, and manufacturing overhead. Let's take a look at those again. So direct materials. Okay, if we, oh yeah, there it is. See, we have a total direct material cost. That's for all 4 quarters combined, right? $31,240. On the labor budget, we have a total 5,750 for the year. And for overhead, we have a total 131,863. Okay, so our total material, labor, and overhead for the year. And that's what's right here. So we add that all together, we see a grand total for those 3 production costs. Now, if we want to break that down, because we do want to break it down into cost of goods sold versus ending inventory, well, how would we do that? I think we did a little bit of that last week, if I remember correctly. How would you get from your total cost for materials to what portion of that is cost of goods sold, what portion is ending inventory? Remember when we did absorption versus variable costing? That was last week, right? We had to take the costs, divide it by the number of units produced, and multiply that by the number of units sold. And that gave us cost of goods sold. And so that's what we do here. They sold 6,000 units. We go back to the selling budget. Remember, this is the selling and administrative budget, but remember we start with the budgeted sales, and we see that that's 6,000 units that they're planning to sell, right? So in other words, we take the total cost for materials, divide it by the number of units we produced, which we could find on the production budget, which was here. It doesn't total it up, but when we total this up, I think we get like 7,050. Anybody double check that number real quick? So it's 1,300 plus 1,150 plus 1,800 plus 2,800. $7,050?
Yeah.
Okay. What we do, we take the total material cost, divide it by the 7,050 units we produced. That gets a cost per unit. We multiply that by 6,000, that gets us our cost of goods sold. Okay. Or, well, they did it a different way. They took the 6,000 units times 3.2 pounds per unit times $1.25 per pound. That works too. And that gets us the cost of goods sold. And then everything else that wasn't part of cost of goods sold was part of our ending inventory. Right? So you could just subtract cost of goods sold from that. Or you could take that cost per unit and multiply it by the number of units that weren't sold. Okay. And same thing with labor. You take your labor cost. You could divide it by 7,050 to get a labor cost per unit, multiply it by 6,000, we get our direct labor cost. Or we know we produced 6,000 units, we know it took 0.75 hours per unit, and the rate was $20. So you could also calculate it that way. Now with manufacturing overhead, we have to divide by the number of units. So we have to take this total, divide it by the 7,050 to get a rate of overhead per unit, multiply that by 6,000 units. That is our cost of goods sold manufacturing overhead. So now we've broken down the total cost and how much of it was cost of goods sold, because we know that's going to be on the income statement, and how much is in ending inventory. That's not going to go on the income statement, right? So any questions there? Okay. Now we can make our income statement. So we take that cost of goods sold, $226,220. We subtract that from sales. How about the sales? It was 6,000 units times whatever the sales price is per unit, right? That's our total sales. So sales minus cost of goods sold gets us a gross profit. Where would we get this sales and administrative expenses? Sales and administrative budget, right? So it says 87,000. Is that what we put here? Yep, $87,000. That was our budgeted cost for the commissions and the transportation. Here's something new, uncollectible expense. That is, what do you think that is? Uncollectible. Waste? Kind of. Uncollectible accounts receivable. It's the money that our customers owe us that we think we're never going to get. We just write it off as bad debt, and it's uncollectible. Okay. And that's an expense, so it saves us a little bit on taxes if we write that off. So we'll take that out, that gets us income before interest. The company has some interest expense. Also some income tax, and we end up with our net income. Okay. So it's basically just what we've always seen before in terms of an income statement, just it's all based on estimated numbers. Okay. Questions or comments? All right, well, we have a problem. Let's do this.
There's a reason why they don't use the same term because the doubtful.
Allowance for doubtful accounts. Well, uncollectible expense goes with that. Yeah, so you would debit, actually, it's bad debt expense. Yeah, it was bad debt expense. So yeah, it is a different term. They could call it bad debt expense, I guess, but that would be too easy, right? Okay, so we're doing problem number 4. Let's go ahead and find it. Chapter 7. Problem 4, okay. Okay, so let's just walk through it and then I'll let you solve it. So they tell us the number of sales in units and then the sales price per unit, right? So you can multiply and figure out your sales revenue. Now notice they tell you the uncollectible expense is 1% of sales. So you just take your total sales revenue that you just calculated, multiply that by 1%, and that's going to go down here under uncollectible expense. For direct material, they give it to you as $2 per unit. So I guess we are going to base it on the same 15,000 units. Yeah, so we're in this case, we're basing it on the units we're selling. The labor rate, it takes half an hour per unit of labor and $20 per hour. So it's 10. That's right. So an easy way to think of that, if it takes half an hour and the rate is $20 per hour, that means it takes $10 of labor for every unit of product. Manufacturing overhead is a fixed amount, so that's easy. Variable sales and administration is $2 per unit. So that's going to be $2 times the 15,000 units. Fixed sales and administration expenses, that should be easy. And then you have to calculate income before taxes. The way you're going to do that, you're going to take the sales minus the cost of goods sold, and the cost of goods sold is going to be direct material plus direct labor plus manufacturing overhead. That will give you your gross profit. You're going to take out all these expenses. That'll give you income before taxes. Figure out what your tax expense is, which is going to be 15% of income before taxes. Take out that income tax expense. That will give you your net income. Right? Right. Okay. So go ahead, work on that, work together, see if you get the right number. Any questions? There we go. Okay, what are the direct material costs? Right, labor? And manufacturing overhead, we know is 15,000, so that adds up to 195,000. Okay, and so our gross profit would be 405,000. Okay, Everybody okay with that so far? And variable sales and administrative expenses. Okay, that's right, because it was $2 per unit. Fixed is 20,000, right? Oops, too many zeros. Uncollectible, right? Because it was 1% of sales. All right, so then what is our income before taxes? Okay, 349,000. Everybody agree with that? All right. Then what is our income tax expense? Okay. 52,350. Very good. And then we can subtract that to get our net income. 296,650, right? All right. Okay. They tried to make that difficult, but it wasn't that bad. Any questions on our budgeted income statement? Okay, then. Okay, this is an interesting question. Which would be a problem? If you overstate sales in your budget or you understate the cash that you're going to collect, which would be a problem? Why? So I heard both answers. Okay. So the first one was overstating sales in your budget. Why would that be a problem? Okay, right, because remember, it all starts with sales. So if you're planning to sell a whole bunch of product and you make a whole bunch of product and you have all these costs and you don't actually sell them, ouch, right? You don't have the revenue and the cash to pay for some of those costs. Okay, what about understating the cash that you're going to collect? Problem? It's good to be accurate, but it's better to be understated on cash collection than overstated, right? It's better to get more money than you thought than to get less money than you thought. So the better option here between the two, overstating sales would be more of a problem. Understating cash collected is kind of a nice surprise. Right? It's like when you wear an old coat and you find some money in the pocket, and you're like, oh wow, there's some money in there.
Missed out on a good opportunity to have money.
All right. So great. We got through the operating budgets. Let's get into the financial budgets. So we do need to plan out for any capital assets. Sometimes you'll see it referred to as capital expenses. What is that talking about? What would be some examples of some capital assets we might purchase? Buildings, what else? Machines, land, right. Big, expensive, long-term assets would fall in this category. Vehicles as well. So it's just like in our personal lives, you know, you might have a budget for your monthly expenses, but if you're going to go out and buy a new car, that's something different, right? You have to think, did I save up enough, or am I going to finance it, right? Am I trading in another car? So you have to kind of budget for those major purchases separately, and then that's going to impact your regular budget, right? If you go out and you take out a car loan, you're going to have monthly payments. So now that financing that you did on that capital purchase is now going to impact your monthly budget. And once we've done those both, we can make our budgeted balance sheet. Now, this is, if you remember that image of the master budget, and it was very linear, it was kind of easy to see how they relate. Well, this is more complex. You can maybe take some time and just sort of meditate on the relationships here. but I don't want to put you to sleep. So what I want to focus on is that most of the money we collect is coming from our sales, right? Customers either paying at the time of purchase or paying us later, but that's most of the money companies get is from their customers. Where do they spend money? Well, a lot of that goes to paying for inventory, materials, labor, overhead, all those costs of either production or finished goods, right? So that's where most of the money comes in and most of the money goes out. And as you see, the accounts receivable has to be collected, right? If it's not collected, it's uncollectible, you have to write it off as a bad debt. All right. Basically, we see the operating budgets over here on the left. We see the financial budgets over here on the right. We see how they interrelate, and they enable us to make our budgeted income statement, our budgeted balance sheet. Right? You had enough of this slide? Let's go on. Okay. Now this gets a little tricky too. This is our cash collection schedule, basically. What this is saying is that we have looked back at when our customers pay us. And we have found that 60% of them pay us in the month of their purchase, and 30% pay them the next month. Okay? So you would just look back historically and figure out when do your customers pay you. Now, once we know that, that means that in the first quarter, whatever we sell in that first quarter, we're going to collect 65% of it. And then in that first quarter, we're also going to collect 30% of the previous quarter. So you get another one of those like zigzag sort of effects. So in quarter two, we're going to collect 65% of what we sell in Q2 and 30% of what we sold in Q1 and so on. And if we actually put that into dollar amounts, those same percentages, you would say, okay, well, here's our sales for quarter one. We're going to collect 65% of that in quarter one. And we had 0 sales in the previous quarter, so obviously there's nothing to collect from that. Looking at quarter two, we're collecting 65% of Q2 sales and 30% of Q1 sales. Here, 60% of Q3, 30% of Q2. So it gets a little confusing sometimes. You have to really, take your time on these and make sure you're looking at the right periods. So we'll practice that when we get to the exercises and problems, but does the general concept make sense? Oh, we have an exercise. Okay, let's go ahead and practice it. We've got time. So exercise 10. Okay. Is this the right one? Number 10? Yep. Okay. All right. So this store collects 55% of the accounts receivable in the month of the sale and 40% the month after. And the other 5%, I guess it never collects. Uncollectible. And that's a pretty high uncollectible. So I would, if I were advising Nona's reappliance store, I would say maybe you should be a little more cautious about who you extend credit to, right? Because 5% of your customers are never paying you. Maybe you need to do a little more of a credit check or just require that some people pay you cash. But anyways, that's a different story. So what we're trying to figure out, how much is going to be collected in February. All right. So here we see February's sales, 70,000. How much of February's sales are we going to collect in February? 55%, because that's what they told us. So we take the $70,000 of sales times 55%, and we see that $38,500 that we will collect in the month of the sale. But we're also going to collect 40% from the previous month. So what would that be? Okay, how'd you get that, Emma? So we take the last month's sales and we're collecting 40% of that. So 60,000 from January times 40% is 24,000. Okay, then we can add them together. We'll know the total amount we expect to collect in February, 62,500. Is that right? Okay, 62,500. Any questions on how we got those numbers? Okay. All right then. Now the same concept applies to purchases. If we make purchases and we have accounts payable, we don't necessarily pay everything we owe every month, right? Even if we try to, if you make a purchase at the end of 1 month, by the time you get the invoice and send the payment, it's already going to be the next month, right? So you're pretty much always going to have something falling into a different period. So in this case, we see that we tend to pay 50% of our purchases in the month of the purchase, or quarter, excuse me, and 50% we pay in the following quarter. So here in Q1, we're paying for 50% of Q1's purchases and 50% of the last quarter's purchases. And so it works the same way as it was with accounts receivable. So if we add some numbers here, let's start in Q2. In Q2, we're paying 50% of our Q2 purchases and 50% of our Q1 purchases. You add them together and you see the total amount that we're going to pay out in Q2. And you can just keep doing that for every quarter. All right, any questions there? All right. Oh, good. Okay, let's see. I think we have time. Yeah, 6 minutes. We can do this. So let's put a lot of these concepts together and see how we can forecast our cash flow. So this is a cash budget for 4 quarters. Oh. This company has a requirement that they keep $10,000 in their bank account at all times. Either that's a policy they came up with, or maybe the bank says you have to keep $10,000 in the account. If they're short, they can borrow money. They have a line of credit, so they could just borrow money, but they're going to pay a 19% interest rate, which is not good, right? So they want to try to avoid borrowing unless they have to. They are going to sell some stock in the first quarter. They've got some tax payments they're going to make every quarter. They're also going to buy a copy machine, and they're starting off the year with $13,000. Okay, so based on that, this is what we do. I know it looks complicated, but I'll make it simple. I'll try. So we start with our $13,000 we have in the bank, right? This is what we expect to collect from our customers coming from our cash collection schedule, and $5,000 from issuing stock. That's the total amount of cash that's coming in. Add that to our beginning balance, and our total cash is this. Then we expect to make some payments, right? We're paying for some direct materials. That's from our cash payment schedule. Our direct labor budget tells us how much we're going to pay for labor. Manufacturing overhead budget tells us our overhead costs. Then we have selling and administrative expense budget. Also, there's that $1,000 for income taxes that we know about, right? So we add all of those operational expenses together, and we see we're going to pay out this much money. So if we've got this much money to work with, and we're paying out that much, we're short. Not only are we short, we need to have that $10,000 in the bank at all times, right? So we need to borrow enough to cover this shortage plus $10,000 to sit in the bank. Okay, everybody follow so far? So now that $10,000 at the end of Q1 is our beginning cash in Q2. Again, we're going to add any incoming cash. We're going to subtract any outgoing cash. And that leaves us with 5,542. Well, that's good. It's positive, but it's still not 10,000, right? So again, we're short compared to that $10,000 minimum. So we're going to have to borrow some more money here. That gets us up to 10,000. Again, that's our beginning cash for Q3. Same thing, we're going to add the incoming cash. This time we're buying that copy machine for $8,500. So that's an additional expense that we're paying for. And okay, this time we come up with 11,265. Great. We have more than the $10,000 minimum, which means we can take that excess, that 1,265, and we can use it to start paying down that loan, that revolving line of credit that we have. Okay, so that leaves us again with $10,000 in the bank, beginning balance, add the cash coming in, subtract the cash going out. Oh, nice, a good quarter. We have, must be because of Christmas. Everybody's buying in Q4. We have $58,000 of excess cash. Nice. We can pay off the rest of our debt, and that's our ending cash. Now we can total everything up on that total column on the far right, except there are two rows that we can't total up. See if you can tell me which two rows we can't total. Look in that total column. The ending cash balance, that's right. It's whatever was the ending cash balance in Q4 is our ending cash balance for the entire year, right? There would be no point in adding up the previous quarter's ending balances. That's not relevant. We want to know for the entire year. That's one. What's the other row that we can't total up? Beginning cash, right? Because we started the year with 13,000, so we just carry that 13,000 over here. So now we're saying we started with 13,000, added that much cash throughout the year, paid out that much cash throughout the year, and you can see excess cash, how much we borrowed and paid back. Ooh, that's interesting. Why did we pay back more than we borrowed? Interest. Interest, right? That 19% interest, it adds up, right?
But you didn't pay it all off.
Okay, Ms. Banner,
I'm saying
Ms.
that's
Wells Fargo.
That's why the question about understating, that's why you don't want to screw that up.
But you don't know that the interest was for the entire year. Did you see? We don't.
21,943 times 19% is 4,000.
Right, but they took out. You only get charged interest for the time that you actually had it, right? So
No, you get charged like a line of credit, depending, like usually you'll get charged interest for every day that you have it.
yeah, but see, they didn't take out this loan until here. They started paying it back. So
Yeah, but
you'd have to do it daily.
That's only an interest payment though, that one
All
time,
right.
that one, 1265.
Okay. So how could you use this concept, like this cash budget we just saw, if you were in charge of managing the cash for a company? Well, we just saw, right? You would figure out how much cash is coming in, how much cash you think is going out, and then figure out where you're going to be short. Or where you're going to have excess money. If you have excess money, great. What do? Do you just save it? You pay off some debt? Do you invest it somehow? Right? And if you're short, where do you get the money? Is there a loan? Can you sell some stock? Right? Angel investors. So yes, so this is why it's important to have a cash budget. All right. Now that we have a cash budget, we can make our budgeted balance sheet, the very last step in the master budget. So here what we see in this balance sheet, we see beginning of the year and end of the year. So I'm guessing they already knew the beginning of the year information and they're estimating what their end of the year amounts are going to be. Oh, and actually, yeah, that's exactly what it is. Because remember, we started with $13,000 in cash and ended up with $36,440. Right? Started with no accounts receivable. This is what they're estimating at the end. There's that allowance for doubtful accounts, inventory. Right? So we've got our assets, we've got our liabilities down here, we've got our equity down here. You see how really nothing different than any balance sheet we've ever seen. It's just that these are estimated numbers based on our budget. Right? Because how would you know what your cash flow is going to be unless you had done a cash budget? How would you know how much inventory you're going to have unless you know how much inventory you're either going to buy or produce? Right? How would you know your accounts payable unless you knew how much you expected to purchase and how much of that you expected to pay for? So after doing all those budgets, we can make this budgeted balance sheet. Any questions? Let's cover a little more. Oh, okay. This is a good exercise for us to practice. So somebody asks us, what is the order in which we should make our budgets? Which budget would we start with? We would start with the sales budget. Which budget would we then make? I heard it? I said it. Production? Yes. Start with sales, then production, and then what? Once you know how much you're going to produce. I can't read lips. What's that? Yeah, our direct materials, our direct labor, and our manufacturing overhead, right? That's all based on production. Great. And then what could we do next? I'm going to wrap up the operating section. So what's left? Think of, yes, the selling and administrative. Think about the income statement. It's sales minus your cost of goods sold and your other selling and administrative expenses, right? So we're doing it really in the same order as the income statement. Great. In fact, at that point, we can make our budgeted income statement. And we're done with the operating section. So let's move on to the financial section. What budgets would we make in the financial section? Okay, cash budget, capital asset budget, and as part of the cash budget, we need to know our cash collection schedule and our cash payment schedule. How much cash do we expect to pay out? How much do we expect to receive? All right, so then what would we do after that? Budgeted balance sheet, exactly, and the whole thing together is called the master budget. I think we got everything right.
Yeah.
Okay, great. And in fact, here it is. Same slide you saw before. So good job, everybody. Sales, production, material, labor, and overhead, selling and administrative, income statement, cash budget, capital expense, cash. Now these budgets, they help us plan, right? And then they also help us compare. After that period goes by, you can look back and see how did we do, right? In terms of sales, if you sold more than you expected, is that favorable or unfavorable?
Favorable.
Favorable, right? What about costs? If you have costs that are higher than expected, is that favorable or unfavorable?
Unfavorable.
Unfavorable, right? So ideally, you hope that you come out ahead in sales and under in costs, because that makes you more profitable. All right, well, we got a few more minutes still, 4 minutes. Let's see if we can knock out another slide or two. And so the difference between flexible and static budgets, I already mentioned to you, with a flexible budget, you adjust your costs based on the actual sales. So let's see what that looks like. Here's a quarterly budget where they're planning to sell 1,500 units, and everything here is based on selling 1,500. On the other hand, here's a flexible budget. Notice that they've got 1,500 units, so that column is exactly the same as what's over here. But we also have, what if we sold 1,000 units? What if we sold 1,500 units, but we changed our sales price? So it's flexible because it's adapting to different scenarios. And then you can see your actual performance and compare it to the scenario that matches that actual performance, and then see how you did. Because again, what if we sold 1,000 units, but we had this budget? We know we're under on sales, but how would we compare our costs based on 1,000 units when the static budget only tells us the cost based on 1,500, right? It doesn't help. But here, it tells us what our cost should be for 1,000 units. So if that's what our actual sales are, great. Now we can see how we did compared to how we should have done. So, okay, we already talked about this. If you compare your actual performance to the budget, that's an analysis of the variance. How much does your actual performance vary from what you planned for, right? As we said, you want your revenue to be more, that would be favorable. If your revenue is less than you projected, that would be unfavorable. And then it's the opposite way with costs. You want your costs to be lower, and if it's higher, it's unfavorable. All right, so here we have, yeah, okay, here's an example of that. So here we see 1,500 units were budgeted. They actually have 1,400 units. Okay, we see the difference in sales revenue. So we can see that they brought in less revenue because they sold fewer units, and that would be unfavorable. Now, how about the costs? They expected direct material costs of 6,000. It's really only 5,550. Well, that's good that their costs were lower. That's favorable. But again, because this is a static budget, we don't know what they should be based on the actual number of units sold. So this is helpful to some extent, but not that helpful because it's not based on the actual sales. It's not based on the budget being based on the actual sales. So again, in the variance column, we're just seeing, are we over or under? And is that favorable or unfavorable? Does that make sense? Right? All right, well, I better stop there. So take your 10-minute break. I'll see you at 2:50.